So right
Thanks.
now the rate of growth is 4.5. The rate consistent with hitting a 2% inflation target is about 6. And that suggests to me what? That inflation, the trend of inflation, the course of inflation is down. It's
Okay, so disinflation is
disinflation, right?
what I think I'm hearing you say then, Steve, is despite maybe conventional wisdom, tariffs should not be inflationary, but they should be an economic drag.
Yes. I think the economy is steadily weakening and will eventually end up in a recession.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. As the world awaits Federal Reserve Chairman Jerome Powell's speech at Jackson Hole today, the question on everyone's mind is, where's inflation headed from here? Is it set to surge as the Trump tariffs start being felt in full force? Or is it set to trend downwards to the Fed's 2% target rate due to a slowing economy? To discuss the latest possibilities and probabilities, we've got the good fortune to sit down today with Steve Hanke, professor of applied economics at the Johns Hopkins University in Baltimore, Maryland. Steve, thanks so much for joining us today.
Great to be with you, Adam.
Thanks, Steve. Well, look, lots to talk about today. And as I just said there, the day that this video is coming out should be the day that Jerome Powell is going to have his big speech at Jackson Hole. We're recording this the day before. He'll be there at Jackson Hole with all the other great economic boombas. So there's sure to be, lots of grand thinking released after this weekend. I want to talk about what you think is going to come out of that. Really quickly before we do though, Steve, just because it's been a little while since you've been on the program, let me ask this intentionally general question just to help viewers kind of get a sense for where your thinking is right now. What's your current assessment of the economy and the financial markets?
I think the economy is steadily weakening and will eventually end up in a recession. As far as the markets are concerned, I think they're overhyped, overpriced, and in bubble territory. The problem with that, Adam, is it's fine to be able to detect a bubble. A lot of people are starting to, worry about a bubble, but it's very difficult to predict whether the bubble will actually pop and when that would occur, or whether the air will just slowly go out of the bubble and we'll have valuations reach, shall we say, reasonable levels.
Mm-hmm.
And we don't know when that would start and how long it would take. So there you have it. You asked the question, and your intro set the table pretty well for a variety of things we can talk about.
Great. Well, looking forward to rolling up our sleeves and diving in. I just want to say your very concise answer there, and I appreciate how direct you were. Reminds me of two quotes. One is from John Hussman, who says that bubble markets force you to make a choice: look like a genius now or look like a genius later.
Yeah.
And there's a lot of people who are thinking they're geniuses now. The question is will they feel that later if indeed it is a bubble and it does pop? So anyways, you say, okay, economy on its way to recession, markets on its way to some sort of reckoning because it's a bubble. So of course, the second quote that pops into my head is, well, okay, beyond that, Mrs. Lincoln, how do you enjoy the play?
I love the quotes. Let me follow up with a little thought with regard to the market and bubbles, and that is, there are actually two decisions that people have to make with regard to bubbles, maybe three, but the two I was thinking about. If you decide to go out, that's one decision. But if you decide to go out, you're eventually going to have to decide when to get back in.
Mm-hmm.
And it turns out that the record of people pulling out and then going back in is not good.
Correct. Now, that's very true. And in fact, Steve, you may or may not know, but I have financial advisors that come on this channel every week to kind of give a market update, but also just be very transparent about how they're managing their clients' books. And they have a lot of horror stories. One of people who got out like in 2008 who still haven't found a way back in because they feel like the market just keeps, running away from them. But to your point, they talk an awful lot about, human nature generally forces us to get out of the wrong times or get into the wrong times, or as the market starts recovering, we start bargaining, with the universe. Oh gosh, I missed the run. If it comes back down again, I'll jump in, but the market just, continues to grind higher from there. So there's a lot of evidence to your point there, Steve, which is as an investor, you want to be very careful about making kind of binary all in and all out decisions.
Exactly. So that gets to another point, and that is my own experience is that you have to be very patient. It's kind of a Charlie Munger rule. You have to be very patient, and you can be looking at something for 2 or 3 years before you buy it. Most people just can't do it. They aren't. I'm a Stoic, and the reason I'm a Stoic, it was brought up when I was a boy. Of course, I was in rural Iowa, and people tended to be, although they didn't read any of the great Stoics, they were Stoics by practice because the weather dominates everything. And there's not too damn much you can do about the weather if you're in the ag business.
Right.
So
the weather doesn't care about your opinions.
That's right. So you become kind of a little bit stoic, and so that's another factor. Now the other thing, with regard to, since we started on this markets and portfolio, another thing is that for shall we say younger folks, the prudent thing is probably to be a little bit biased to just staying the course. But older people should be looking at their portfolios because they probably have big capital gains. And let's say they have a traditional, want to use a 60-40 rule, 60% stocks, 40% bonds. Let's just assume that's the case. Well, now, if they went back and looked at their portfolio, maybe it's like 80 or 85% stock,
right?
Because they have a huge capital gain. So the recommendation there would be rebalance the thing.
So, Steve, we actually know from the data, sadly, that what is it? Retirees basically have the highest exposure to stocks in their portfolio as a percentage of their portfolio than they ever had right now.
Well, that's an interesting observation. I wasn't aware of that, but I'm not surprised, by the way. That's why I said what I said.
Yeah, it's corroborative of what you just said. Yeah, exactly.
But that would be my instinct, and the reason for that is the following, and this gets back to the thing that makes the economy go around, and kind of my theme song, money dominates. It's all about the money supply. And what happened with the pandemic, we had a huge increase in the money supply. At one point, we actually had the money supply growing at a little over 18% per year, which is the most rapid rate of growth in the money supply measured by M2 since the founding of the Federal Reserve in 1913. So what happens after that big injection? The first thing that happens, asset prices start going up. So real estate goes up, land goes up, stock market goes up, all assets start going up. And who owns the assets? Well, the people with a positive net position on their balance sheet are people who are older, younger people it's negative, or some older people it's negative too. But the bottom line is, to give you an idea, just to put this thing into context, Adam, if you looked at the billionaires in the United States and took their wealth as a percent of GDP in January of 2020, the month before the pandemic hit, it was 14.1%. Now that percentage is 21.7%. So who made out by this surge in the money supply, surge in inflation, surge in asset prices that we've had. Well, people who owned assets, well, they tend to be on a demographic basis older people. So right away, intuitively, I know that they must be very heavy into equities.
Well, they are. They also, just to your point, though, who benefits from the policies that we've been pursuing? It's not just equities that have run up, right?
Oh yeah,
it's real estate, although not so much commercial these days. I mean, it's everything else, cryptos, gold, whatever. So if you are fortunate enough to own assets, you've done very well. If you don't own assets, you've just gotten clobbered by the increase in cost of living, and you haven't had any tailwinds from assets to help you. And it's interesting you're bringing all this up here, Steve, and I do promise we'll get to inflation in just a second. But I literally just released a video on this exact topic about 2 hours before our recording here. And here is the chart that I made the centerpiece of the video, Steve. And you'll see here, it's a measure of net personal wealth in the US. And the top 10% is really running away from the bottom 90%, but that's nothing compared to the top 1%, and how fast, really exponentially, their wealth has been running away from everybody else. So, those who have the assets, the more assets you have, the better off you're doing here. So obviously this, this opens a lot of questions about sort of the direction of society, both as you have extreme wealth concentration like this, from the haves to the have-nots, but there's also, as you were talking earlier, there's a demographic element to this too, where wealth is correlated with age, and you've got these younger generations that are trying to come up, and they just can't form capital the way that previous generations were able to do at their age.
Yeah, this is a great chart. Now, what's the sourcing on that? What's the if I want to go look at the raw data and not a chart, where do I find this?
Yeah, to be honest, I don't know off the top of my head. I pulled this from an article from Quote the Raven, which is a very popular Substack.
Yes.
I am in contact with the author there, and so I can ask him what the data set is, and
Yeah,
have him send it to me, which I can send to you.
that'd be great. Now, this is very interesting. Now, this chart, it's actually better than my billionaire thing. My billionaire thing says the same thing, but you've got it more refined. Now, what's the lesson in this? The lesson we come to is actually something that is contained in my new book that I co-authored with Matt Sakurki. It's called Making Money Work. You might put that up on the video when you produce it. And we argue that one of the key things and objectives of monetary policy should be neutrality. And what's neutrality? That when the money supply changes one way or another, it should be neutral as much as possible in terms of its effect on different sectors of the economy and different income groups.
Mm-hmm.
And your chart shows this is what the Fed, in conjunction with the fiscal authorities in Washington, have done. The politicians have made for a non-neutral monetary situation, and that's the Fed. That's the Fed. And the fiscal part of the thing is also in there because taxing and spending is not neutral. It favors certain groups over other groups. And it turns out that, think about it, whether you're conservative or whether the limousine liberals are running Washington, they're all doing the same thing. They're favoring special interest groups, and they're making the income distribution in the United States worse and worse and worse. And of course, what does that give fuel for? Number one, it gives fuel kind of ideologically for people on the left. All the Marxists jump on this thing and raise hell about it, and I think that's bad. And that's a kind of at the theoretical level, but at the practical level, it makes society anxious. And as you pointed out, we're finding now what happens with young people. They graduate from college with a lot of debt and none of the assets. They haven't accumulated any assets. You know, when I graduated from college, I had a huge portfolio, actually. I mean, not portfolio, balance sheet. Now, why did I do that? I had that because I was working on the farm and all kinds of construction jobs and everything else when I was in high school, even when I was in junior high, even when I was in grade school. I was making money. I had a bank account, and there was something in the bank account.
Mhm.
So then I went to college, and I had three. I was going to college and trying to avoid flunking out. And in addition to that, I always had three jobs at the same time. I was working as an assistant for a professor, a gopher as they call him. I was working as a bartender at Tulagis in Boulder, Colorado, where the University of Colorado is located. In that day, by the way, that Tulagis was pumping more beer than any beer joint in the United States. You can Google a thing. It's a very famous thing, by the way. And I also had a part-time job at the university, the maintenance department. You know, they're running around, you know, fixing broken windows and that kind of stuff. So that was one thing. Then I started graduate school and was a research assistant, had a research grant, and in addition to that, of course, by the time I was a graduate student, I was on a full tuition. I wasn't paying any tuition, and then fortunately, I fell into a job as an assistant professor at the Colorado School of Mines. So I was making out like a bandit. So when I graduated from college, what did I do? About the first thing I did is bought a 24-unit apartment building.
Oh, wow. Very,
So,
very,
so
very
there was
prescient for a young.
no debt. I mean, the balance sheet, I learned very quickly when I was a kid, there's nothing more important than a balance sheet.
Mm-hmm. Or a healthy balance sheet, but yes.
Yeah, well, that's true.
Yeah. So, Steve, you know, I would say, look, you can still, there's still opportunity to get ahead, but it is, I think, and I think you see similarly, I think it's a lot harder, right? So, I mean, when we can argue whether today's generation has the same work ethic as you did, and I'll put that aside for a moment,
Yeah.
but
Well, let me answer the question. They don't.
but even
Yeah.
that, let's put it aside for a second. Let's assume they do, right?
Yeah.
First off, the cost of college education has increased faster than, I mean, almost any other good or service that we can think of over the past couple of decades, right? It's been right at the top there. So college is a lot more expensive relatively. Um, the essentials of life are much more expensive relatively. Housing, things like that, right? If someone graduating now wanted to buy a similar apartment building, or even forget that, just a starter home, its price as a percent of median income is much higher than it was back in your era. And the ability to earn an income coming out of college, I think is also getting diminished. Not that you can't do it, but we're seeing that the unemployment rate amongst recent college graduates is now entering, you know, kind of recessionary levels. We're seeing that companies are pretty much now beginning to say, and they have for a while with outsourcing and previous automation, you know, they're starting to get rid of the entry level jobs with technology. AI looks like it's probably going to pour gasoline on that. So there is just a much steeper hill to climb. And again, I'm not saying that you can't be scrappy and be successful here, but I do think you have a steeper hill that you've got to climb to do it now.
Yeah, I think everything you said I agree with, and my observation is that uh, the problem with the universities, first the tuition. Why does that go up? It goes up. The administrations at the university are just huge now. I mean,
Right.
there's a provost, there's an assistant provost, of this, of that, a dean, just a
Right.
phalanx of. At Johns Hopkins University, for example, where I'm a professor, I've been a professor now, going into starting my next week, I'll start my 57th year.
Holy cats.
So I've been around a while and I watch what's going on. and the administration, the layers of administration are just unbelievable. And whenever I make this observation, my colleagues remind me that Hopkins, relative to most universities, is lightly administered.
It's so depressing.
So the tuition thing it's all an administration thing. They're
Well,
hiring.
but Steve, sorry to interrupt, but what enabled the bloat of administration? And it was the fact that the government got into the student lending game and basically pushed out the private lenders and was willing to give loans for whatever colleges were willing to charge for tuition.
Yeah, well, that was part of the thing. The other part is that there are a lot of federal mandates that force administrations to increase in size. You got to have a regulator for DEI, and you got to have a this and a that and so forth. So there's a mix of things, but the bad news on the cost increase side, it's all mandated either directly or indirectly from the government, and it's fed by the bureaucracy. What do bureaucrats do? Their main thing is to expand their bureaucracy.
Right, justify the bureaucracy's existence and then expand it. Yeah.
Yeah, right. I mean, so that's one part of the picture. The other part of the picture. So the cost has gone up, but also the level of instruction. And by the way, the number of universities and junior colleges and everything else is expanded massively since. Remember, I entered the university when I was 17 years of age, and that was in 1960. There weren't that many universities then, by the way. Now every podunk college is a university. Every place that was a podunk college grants PhDs of all things. I mean, it's a joke. So the level of the whole thing has gone down. And the practical side of that, even at great universities, by the way, where I've either been associated, you're out there in California, I think.
I have been to recently.
And where was one of, I've only been a professor at 3 universities, all great. Colorado School of Mines, #1 mining school in the world.
Great school.
Johns Hopkins University, one of the top 10 universities in the United States. University of California, Berkeley. And what all these things, with the exception of mines, they're all engineers, so they teach them how to do something at the Colorado School of Mines. They don't have any problem getting jobs, believe me. But the general universities are, in general, not training people how to do things. So in my courses, I teach them professionalism. You got to be there. You got to be paying attention, so forth and so on. And I teach them actually how to do things. That graph that you had up there, they know how to do it. They know where to get the data and so forth and so on. So this is a big problem because, I know this for a fact because all my students, and this has been written up in Bloomberg and Barron's and other publications. My students, 100% get their top picks on Wall Street. They all go to Wall Street at the top. And the people who employ them always call back and they say, oh, you got any more of these people? It's just great. After 10 days, Joe Blow was up to full speed. We didn't even have to train the guy or gal. And I said, really? I said, how long do you normally have somebody in training? And they say, oh, minimum 6 months, maybe a year or so before they can do anything useful. And what does that mean for somebody who's hiring? It means it's very expensive. They have to invest a huge amount in human capital to train these people so they can, push a pencil or do whatever they're doing.
Right, and not all of them work out, so there's wastage there. So I very much appreciate, Steve, you being this transparent, being inside the system and being inside, a highly respected organization like Johns Hopkins, to be able to call this out. A lot of people in the system will not call these things out, especially the dilution in the quality of the education system. And I know you and your class is an example, is an exception. But kudos to you for doing that. In fact, I was just having a talk with Greg Lukianoff, who's a co-founder of the book, The Coddling of the American Mind. And he talked about how big employers have been telling him, hey, a lot of the graduates we're getting from these Ivies and other, big name schools, they're just not working out. In fact, we're actually reducing our recruiting efforts there. And Greg was like, can you guys please publicly say that? Because, his whole point is like, we kind of can't address the problem until we admit we have it. So I appreciate you being so transparent.
Well, it's easy for me to do.
All right. Well, look, I could talk about this all for the entire interview, as regular viewers of this channel know. I come on to talk about this topic a lot. That being said, though, I'd be remiss not to bring it back to inflation because you're one of the top specialists out there on inflation. And I want to remind folks, in the years I've been interviewing you, I'm sure we're going to talk about the quantity theory of money, and you rely heavily on that formula for good reasons to predict where inflation is going. And that allowed you and your partner to make the prediction that the CPI was going to rise to 9%. And this is when CPI, I think, was at like 3 or 4%, and 9% sounded crazy high, but you were proven correct within a very short period of time. You then correctly predicted it was going to start declining quite severely, which it then did. So kudos to you on that. Back to the things I talked about in the intro here with Jackson Hole. Where do you see inflation going from here?
Okay, that's a little bit of it. There's kind of two parts to this.
Unpack it any way you need to.
Yeah. Okay. So based on the quantity theory of money, the money supply is essentially where the stock of money today is more or less where it was about 2.5 years ago. So you basically had a contraction, Adam, in the money supply, and now it's started increasing a little bit. And the rate of growth in the money supply in the United States is 4.5%, if we use M2 as a measure of the money supply. And the rate that is consistent with hitting an inflation target of 2% and based on the quantity theory of money would be just a tad over 6%. Let's just call it 6%. So right now the rate of growth is 4.5. The rate consistent with hitting a 2% inflation target is about 6. And that suggests to me what? That inflation, the trend of inflation, the course of inflation is down. It's
okay. So disinflation is
disinflation, right? We're at 2.7 now. This month, well, the month before was 2.7. Everyone said because of tariffs it was going up. Well, I said no, it was probably going to stay the same or go down, or certainly not go up very much. So that's the underlying cause and behind where inflation is going, because inflation is always and everywhere a monetary phenomenon. How much money in the system it dictates where the overall aggregate inflation, like the consumer price index, where that's going. So it's going down.
Okay, so sorry to interrupt, Steve, but just so I can clarify.
Yeah.
For the folks that have been pointing to M2 and saying, hey, M2 is rising, therefore expect more inflation, you would say, yes, M2 is rising, but it is not rising fast enough to be inflationary. We're still in deflation given the current rates.
Right, exactly. That's exactly a good summary. And one way to put it, the monetary policy now is tight. It is tight. And why is it tight? It's tight because the money supply at 4.5% is less than the rate consistent with the 2% target of 6%. So we're in a tight money zone, and that's why the thing is trending down. That's the big trend pushing the thing. Now there's a little problem, and that is we have this whole regime changing with tariffs. And what are tariffs? Well, tariffs, who pays them? Number one, forget what they tell you in Washington, D.C. the importer, the American importer, pays all the tariffs. Foreigners don't pay the tariff. Americans pay the tariff. And so that means what? That means all imported goods are going to be faced with a sales tax. And that tax will be added to the price of whatever these imported items happen to be. And it's very high. Right now, the Yale Budget Office calculates that the tariff rate, the effective tariff rate that we are going to be facing right now, 18.2%. The Smoot-Hawley tariffs, which were the highest in the United States and put a stake in the heart of the Great Depression in 1930, the Smoot-Hawley tariffs, they were only just a little bit over 19%. I think they were 19.7%. And now we're at 18.2. So this sales tax is huge. Now, to put it into context, and I was actually just working on this morning, if you look at the estimates of what they think the revenues will be that will be generated from these sales taxes, or as they call them, tariffs, it will amount to about half of the so-called tax cut that was associated with the big, beautiful budget bill that was just passed. So we just passed a much advertised by Trump and company and many other people, the big, beautiful bill. The big, beautiful bill extended the tax cuts of 2017 and made those permanent.
Right. Not an incremental benefit, but it preserved what was there before.
It preserved what was there before. So what has happened with the tariffs, we in a way you can think of money going into the taxpayer's pocket because he's not gouged by increases in taxes due to the big, beautiful bill, but it's going to be taken out. About 50% of that bundle going into his pocket, half of it's going to be taken away with these tariffs, which are a sales tax. So it's a very big deal.
Can I dig into this a little bit? I don't want to interrupt your flow. If you don't mind. So I follow your logic so far. Let me just ask, and this is no agenda. These are just honest questions I have. So first off, is this the same as sort of the Smoot-Hawley tariffs in that era? And the reason why it might be argued that it's different is that these tariffs are being used to renegotiate new trade deals, right? So in other words, yes, the tariff may be placed on certain products from country X, but we may be getting all sorts of additional favorable terms on trade with that country. Like they're going to, take off tariffs in their country and our goods, so we're going to sell more there. They might actually move their manufacturing to U.S. plants to avoid tariffs and create U.S. jobs. In other words, it's not just a sales tax. There are potentially other benefits coming along with that sales tax that may offset it, or at least partially.
Well, you have to work through these so-called benefits. I mean, you're basically giving the propaganda of tariffs, the benefits of tariffs. There are no benefits of tariffs. These so-called advantages are disadvantages, because when you work the numbers, any way you cut it, it's going to cut about it's a wide range depending on how you do the bench calculations, but using kind of standard methodologies and doing bench calculations, these tariffs will cut into American GDP and cut it by about 2 to 8%. It's a big range, I know, but there's just no way you can come up with a benefit out of that. I mean, it's just a wrecking ball. Tariffs are a wrecking ball. And this leverage thing, I would add, they're worse than Smoot-Hawley, because Smoot-Hawley was fixed. And there was a commission actually to reevaluate these in a systematic way. There were rules of the game that were being followed. They were terrible, and one reason we had such a deep and long Great Depression was Smoot-Hawley. There's no question about that. But it was all systematized. There was a template for handling changes in the Smoot-Hawley tariffs and so forth. There is nothing in this because Trump's using this for leverage. You say, well, that, and you put the positive Trumpist spin on it. I'll put a negative spin on it, Trumpist, and that is, we have a tariff today on you. But what if you don't deliver what you say you're going to? Then I'm going to jack the tariff up on you.
So it gets worse.
And that's what's going to happen in Europe. You said all these investments coming in. The EU promised to send 600 billion in additional investment in the United States. Well, the EU has no authority. They can't mandate that private companies in Europe invest $600 billion in the United States. The whole thing is smoke and mirrors. And by the way, most of these things aren't written on paper. They're not signed by anyone. We don't know what in the world is actually going to happen. So there's not the fixity about the bad Smoot-Hawley tariffs. There is a great deal of uncertainty about and flexibility in this idea that we're not just using leverage for economic reasons, but for kind of as a weapon of choice. I mean, this is warfare we're talking about.
Okay, and that actually makes great sense to me, which is, yeah, these tariffs aren't just fixed at 18.2%. Your example, Europe doesn't deliver what they say they're going to, so Trump says, okay, great, I'm bumping them up to 40% now, right? Yeah.
Right. Or some of the loopholes that he's allowed, supposedly, and we don't know about the loopholes. He's allowed certain maybe he'll decide to close the loopholes.
Yeah.
We don't know. The problem with the president, he's a very mercurial personality. And mercurial personalities, you can't predict from one day to the next what in the world they're going to do.
Well, by definition, you can't if they're mercurial. Yeah. So let me just ask you this question. Sure, this is a current administration talking point, but just tell me if there's anything here or not. Which is, let's go back to my example. Let's say South Korea. We say we're going to put a X% tariff on Subarus unless you make them here in American factories, right? So if they do that, nobody pays the tariff on the Subaru because it's getting now manufactured in America. So Americans get same price Subarus, except they get additional jobs.
Hold on. You made an assumption that's incorrect. Why do they produce Subarus in offshore? Because it's cheaper. When they produce them in the United States, it's going to be more expensive. The price tag is going to go up.
Okay, so it may not be same price Subarus. What you're saying?
No, yeah, you've assumed. I mean, you're like a professor in a classroom, on a blackboard. You say, assume that, this is what the economists, in the classroom, they say, they use the Latin phrase ceteris paribus.
Right, all things being equal. Yeah.
Yeah.
Okay, so okay, but to your point, all right. So let's use your point there. Let's just say one way or another, Subarus get more expensive. So Americans may substitute and just say, well, okay, I'm going to buy American now. Are there any benefits from that, of the substitution to a non-tariff domestic product?
No.
Okay.
You're going from low cost to higher cost. That's the way to all of these things. Once you really work it out, the configuration of manufacturing in the world is settled, kind of in a general equilibrium, as we'd call it in economics, and things settle where there's a comparative advantage of settling it there. David Ricardo, the great British economist, worked all this out a long time ago. The comparative things end up where they have a comparative advantage to being produced, and that's the way it is now. Trump wants to upset the apple cart and change all of that. And he says, I don't like the way the market has done this. He's basically saying, I don't like this market arrangement. I want to rearrange the deck chairs in another way. And when you do that, that simply makes you go from optimal, or I'm in quotes, optimal low
Sure.
cost to some higher cost regime.
Okay, so any free market enthusiast should hate this because
Yeah,
it's
no,
messing around
no.
with natural market
You,
forces.
you can label what's going on, and this is a continuation of Biden, by the way. It's not Trump. Biden had exactly the same philosophy. The difference in Biden, of course, he wasn't the sharpest knife in the drawer, and wasn't as fast and as comprehensive as Trump. But the ideas are the same. The philosophy is the same, and the philosophy is an interventionist philosophy where the government knows best. Trump knows best. He wants the CEO of Intel fired because he doesn't think the guy's any good. He wants this to happen and that
Yeah.
happen, and he micromanaging. He wants to run the American economy as Trump Enterprises. But don't forget, that's exactly what Biden was doing, and that's been a pattern. We've been sliding down this slippery slope for. What do you think Obama was doing with Obamacare and all these other interventions?
Well,
Well,
this is just like the bloat in academia we talked about earlier, right? Which is just government wants more power over time,
yeah,
right?
yeah. Ultimately it is a power game, and what we say, everything is becoming more politicized. And you can't do anything now in life without having a politician having their finger involved in the thing. You're facing some regulation or some sanction or you're receiving maybe a subsidy. If you've got a good lobbyist and you're on the right gravy train,
Right.
you have a big thing. But let's get back to the inflation thing. We really could have a great and very long brainstorming session here. But let's
Sure,
go.
no, this is useful. Let me just ask one question about tariffs related to inflation, so you can include it
Yeah,
in
well,
your.
that's what I was going to come back to. I said due to the inflation is always and everywhere a monetary phenomenon. How much money in the system will give you the general price level, and whether it goes up, whether it goes down, where it is. But there's a lot of movement within the general level, and then that comes back to the tariff thing. Is
Yeah.
that
So when you said that the money supply is increasing, but not enough to push the inflation rate up, right? We're going to be disinflating. It does seem like you think that tariffs are going to be, taking money out of Americans' pockets. A lot of people will call those price increases inflationary. Does this get added on to the money supply increase, or is
no,
this
no,
actually?
no, no. What it does, it changes the relative price of things. So things that are imported with a tariff, if I'm buying a bottle of wine now from France and paying a 25% tariff, obviously it's increases the price of the French wine.
And it'll go up relative to a
Relative,
California Chardonnay, yeah.
right, relative to California wines. So that's one thing that happens. But if the stock of money remains constant, that increase if I'm spending more on my French wine, I don't have as much to spend on California wine or other things, and the price of those won't go up as fast. So that's why the aggregate stays kind of the same. You might get, by the way, a little one-time pop in the general price level due to these relative price adjustments, because prices are sticky, and you might get a little pop up, but then it'll start trending down again.
Okay, so
But the price increase that you see on these particular imported products for that is not inflation. That is a relative price increase of those items relative to other things in the overall economy.
okay, so that's a very important point, which a lot of people out there are saying tariffs equals inflationary. You are saying no, you may see prices pop to a certain extent on the tariffed goods, although you expect those pops to sort of dissipate over time.
Right, and the pops with the if they show up in the general price level, it will be just a one-time show up, and then it goes away because of what's happening with the background money supply numbers. Now, let me give you an example of how this works so that is less theoretical. In the 1970s, we had the two oil shocks in 1973 and 1979, and Japan imports all of its oil, and the price of oil goes way up. That would be equivalent of imposing a tariff on oil imports in Japan.
Yep.
There wasn't a tariff; it just the price went way up. And the Bank of Japan in 1973 said, well, we'll accommodate that price increase in crude so it doesn't hurt everybody as much. And they goosed the money supply. And what happened? You had inflation went up. And everybody in Japan says, oh, we have inflation because the price of oil went up. No, you had inflation because the Bank of Japan decided that they were going to let the money supply go up to accommodate the price of oil going up relative to everything else. Then 1979 came, and the Bank of Japan learned their lesson. The price of oil went up, but the Bank of Japan did not goose the money supply. And what happened? Inflation didn't go up. The price of oil went up relative to everything else being bought in Japan, but the price of all other goods and services tend to be muted. It went down. And the overall price index as a result in Japan stayed, more or less the same as it was before the price increase in oil. So the second time the price increased in Japan for oil in 1973 was a different ball game, and it didn't create inflation. The first one, everybody got it wrong. They said, oh, the price of oil is going up. That's causing inflation.
It was the monetary response that
Right.
Yeah.
You had two different monetary responses.
Okay. So what I think I'm hearing you say then, Steve, is despite maybe conventional wisdom, tariffs should not be inflationary, but they should be an economic drag.
Yes.
Okay. So
now, why are they an economic drag? Let's use a simple example. Let's assume that you're selling me something, and you're in some foreign country. So Taggart is selling Hanke something, and Taggart's off in some foreign country someplace, and you sell it to me for the price and on the terms that we agree to, and that means if you're willing to sell it, you benefit. There's a benefit, and if I buy it, I also benefit. So the seller and the buyer benefit, and something is generated that economists call gains from trade. That's why trade wouldn't occur if there weren't gains from it. So they're gains. Now, what's the tariff do? The tariff is a sales tax that goes into those gains and sucks part of them out and puts them in the US Treasury. Now, at the margin, and everything in economics happens at the margin, there'll be a lot of transactions where the gains from trade are not as great as the tariff tax that's being imposed on those transactions. And in those cases, the transactions won't occur. There are no possible net gains from trade if the tax you're imposing is greater than the before tax net gain from trade that was anticipated.
Makes sense.
So that's why what you said is correct. That's to explain why economic activity and trade will go down. Taxes make things go down, not up. Taxes don't stimulate things, they crush things.
So, okay, so let's get to where the rubber then meets the road here. So we have Jerome Powell, who by the time this video releases tomorrow, Steve, If Powell hasn't talked already, he'll be talking within the next couple hours. And the world is, waiting with bated breath to hear what he has to say. Given your outlook, I mean, it sounds to me like you think that the Fed will likely start cutting, and I don't necessarily looking to get you to commit to that. You think they'll do a cut in September, which the market still believes they will. But over the next year, presumably the Fed would be cutting if it's seeing the same things that you are, correct?
Well, no, they're not seeing the same things. They don't even look at the money supply. I'm looking at the money supply. My point is that he will be talking about what? He'll be talking about a lot of data. He's data dependent. He's looking at all economic data. So he'll talk a lot about economic data and then reach a conclusion about where the one thing the Fed pays attention to besides economic and financial data are the Fed funds rate. That's what you were talking about, the interest rate the Fed says. So then he'll jump to that. That's the wrong way to go. Monetary policy is not about interest rates. It's about changes in the money supply. He should be talking about the fact that the money supply is growing too slowly and ways to allow it to increase a little bit faster rate. So he should be talking about taking quantitative tightening off. They're still tightening, reducing the size of the balance sheet at the Fed. That's one thing. He should also be pushing ahead for actually something they're pushing for, and that's to take these supplemental liquidity requirements off commercial banks, because those liquidity requirements require banks to reserve on safe assets like treasury bonds the same way they reserve for risky assets. So as a result, it would give the banks more capacity to make good loans
make loans, and then velocity would increase, right?
Well, we just economic activity would increase.
Okay.
No, velocity would stay the same.
Okay.
So my point, and this we're talking now today, is I forgot what date it is. The 21st.
It's the 21st of August.
Yeah, 21st. As we're speaking today, the 21st of August, John Greenwood and I just published a column in Forbes magazine. Forbes, excuse me. That was a Freudian slip. The title is "Monetary Policy is not about interest rates; it's about the money supply." And to give you an idea of how you can get, and I'll use just two examples in the United States to illustrate why interest rates are irrelevant. Everybody focuses, and you use the right word, which we use, by the way, in our article. You said everybody's waiting with bated breath. For what? What's going to happen to the Fed funds rate? And I'm saying with Greenwood, that's all irrelevant. It's
the wrong thing to watch. I got
it. And here's why. Let's go to the great financial crisis. Let's take two huge episodes where interest rates, everybody focused on interest rates, just got it all wrong. One is after the great financial crisis. If we look at the U.S. between 2010 and 2019, the Fed lowered the Fed funds rate to 0.25%, rock bottom, 0.25%, and they left it there. They also engaged in 3 episodes of quantitative easing, and so everybody traditionally they said, "Oh, easy money. We're going to have." Some people were even saying we're going to have a hyperinflation. Wrong. The money supply grew at very close to Hanke's golden growth rate, consistent with the 2%. It grew between 2010 and 2019 at 5.8%, Adam. And where did inflation grow over that period? 1.8% per year. So the people focused on the interest rate just got it all wrong. We had monetary policy that ended up being more or less right on the dot. Now, what happened with the pandemic, we had a different situation. We had, again, 2020, 2024, Fed funds were pushed down to 0.25% again. and we had large-scale quantitative easing. And everybody looking at that said, oh, we're not going to have inflation. Now they turned they said, oh, we're going to have just what we had after the great financial crisis. We had very low Fed funds rate. We had all these 3 quantitative easings, and God, we didn't have any inflation. Same thing's going to happen this time. And people like Greenwood and I said, no. This time the money supply shot up, and it averaged over that period of time 17.3% per year between March 2020 and March 2022.
Yeah.
As a result, we had what you said. The inflation did what? It went up to 9.1% in June of 2022 and averaged over that whole period 7%. So the monetarists got it right, and the people focused on interest rates like Powell and every one of those central bankers, by the way, that is what they will be talking about. Whether they're going to increase or decrease their base rates, every single one of them will end up talking about that. And by the way, that's what Trump and Powell are quibbling about. Powell is holding steady, and Trump wants to have a 3 percentage point reduction in the Fed funds rate. But their philosophy and their view of things is the same, and it's wrong. They're looking at interest rates. Monetary policy is not about interest rates. It's about changes in the money supply.
Right. So they're arguing about pulling the wrong lever.
Right. Exactly. So I'd say in a way, their fight is kind of ridiculous. And in another way, ironically, Trump actually has a point. He's basically saying they're too tight, but he should be embracing the quantity theory of money. So you're too tight. The money supply is growing below Hanke's golden growth rate of 6%, rather than fooling around with all this battle over the Fed funds rate and trying to fire governors of the central bank and all the rest of it.
Right. Well, so, okay, so great. So it sounds like you think this, in spite of itself, the Fed may actually be more successful than perhaps it even wants to be at bringing down the official CPI to 2.0%. Because if we're flying, with a declining altitude, I guess, to murder the analogy here, we don't have enough money supply to be pushing inflation up. It's disinflating, as you said earlier, right? So
Right.
presumably through your calculations, I'm curious, where do you see us headed inflation-wise? I imagine it's below the Fed's 2.0% target.
Well, the target are below. I've always thought, and this might be thrown off by these temporary little pop-ups due to the tariffs, but I think there's a fairly good chance that we'll end up at 2% or below at some point in the year. We're running now. It's getting late in the year. We don't have that many months left.
So would you say you think we'll get to 2% or below in the year? Are you talking rest of 2025? Are you talking next 12 months?
Give me a break. Give me 12 months.
Okay, good. That's all I just wanted to clarify. Okay, so within the next 12 months, you think the Fed possibly very much in spite of its current focus may actually succeed. And do you think there's a danger of it succeeding more than it wants to, where inflation gets a one handle and the Fed is all of a sudden saying, hey, wait a minute, we're back to wanting more inflation like they were saying pre-COVID?
Not really. I think given the turmoil that's going on, they want a steady as you go thing. They're not going to be in the business of making sharp changes.
Okay.
They're in a hunkered down mode. You have the president of the United States and all these sub-secretaries and kind of basically non-entities. I mean, you had somebody taking shots at Cook, the governor of the Fed. I mean, he's a low-level political appointee. He's not even a secretary of a department or anything. So if you have incoming fire, what do you do? If somebody's shooting at you, what do you do?
Right.
Well, you barricade yourself in your house and hunker down.
Exactly. Yeah, hunker. Yeah. Well, yeah.
You don't get out there waving a white flag or whatever, or the charge of the light brigade from the Fed is not going to happen.
Right. Well, so similar question though for the president, will he, regardless of what Powell does, will he get what he wants, right? Which is basically inflation expectations will come down.
What he should get. Actually, a week ago, I had a 2-hour meeting at the White House and delivered "Making Money Work" to one of the right people. He should, if he wants to redesign the Fed and get away from what they're doing and get on the right track, and base things on the quantity theory of money, getting that back at the center of the thing, which by the way, Powell and all of the people at the Fed have thrown overboard. Mm-hmm. So you want to get it on board, and you want to get commercial banks back at the center, and rational banking regulation and all those things. You read Sikorsky and Hanke, Making Money Work, very carefully, because that's basically what that book does. It has a 3-legged stool: getting the quantity theory of money back in the picture and getting away from this interest rate obsession. Look at the money supply. Point number 2, well, who produces most of the money? Commercial banks produce most of broad money in the United States. So you have to have rational, good regulation, because that's part of bank regulation, part of monetary policy. And the third thing is to have neutral money. You don't want these distortions and various sectors being favored relative to other sectors, various groups in the economy being favored over other groups. You want neutral money. So quantity theory of money, keep your eye on the money supply. Point number 2, keep your eye on banks and bank regulations, because they produce most of the money. The Fed doesn't. And 3, the monetary framework and money supply should be neutral.
Well, Steve, I got to say, most people
that comes back to that chart. That's why that chart you had is excellent, because if you had a neutral monetary policy, by the way, if that had been your framework, you wouldn't have that huge spike.
Right, they would move in tandem.
Yeah, everything would be kind of a little flatter, the lines.
Yeah. So I got to imagine that most people viewing this video, Steve, are saying, "Amen, brother. Like this makes total sense. We'd love to see this." I can say from the Fed watchers that I interview regularly on this channel, one of their chief criticisms of the Fed is that it doesn't have a framework, that they kind of just sort of wing it. Like, hey, we'll know, as Powell likes to say, we'll know the neutral rates by its acts, like almost kind of like pornography. Like, I can't tell you what it is, but when I see it, I'll know it, type of deal. Where you're saying, no, there needs to be a real framework for this that's based on the quantitative theory of money that should be at the center. And then you have your other 2 requirements that seem absolutely rational. So I think a lot of people would love that. So, there does seem to be an appetite right now for at least revisiting kind of how the Fed is structured. We've heard Treasury Secretary Bessent talk about that. And of course, the president's made his own comments. Do you see there being an opportunity to introduce this type of reform, anywhere in the near future?
Well, that's what I'm trying to do. I mean, the playbook is Making Money Work by Matt Sikorsky and Steve Hanke. It's all in there.
So everybody who's thinking about reforming the Fed should read this.
Yeah, it was just released on May 6th. So, I mean, give me a break. I'm working on it. I mean, as I say, I hand delivered the thing to the.
I mean, I'd like to hear that you went to Capitol Hill and the White House, and you actually were handing out copies to the.
I gave a 2-hour briefing, so had a great session.
I'm curious, how was it received?
Well, but I'm talking to professional people. There weren't any political appointees in the room.
Oh, okay.
I mean, these weren't political people. These were the professional people that deal with these things. But they invited, and I didn't invite myself. I was invited, and I made my thoughts known, and there was quite a bit of interest in it. I mean, it was more like being in a graduate seminar, you see.
Okay. But I like the fact that there was pull there for you, that this wasn't you trying to pry the door open, that this was people there saying, let's
No,
get this
no,
guy's ideas in here.
Rule number one in Hanke's rule book, you don't invite yourself to places like the White House.
All right, well, look, let me get back to the question I was asking earlier, which is, might the president actually get what he wants here, despite what Powell does? Meaning, I think the big reason that Trump is browbeating Powell is because he wants to reduce borrowing costs for the government, for corporate America in general.
That's really the wrong argument. And number one, you might see the Fed funds rate go down because the economy is slowing, the labor market's getting weaker,
Right.
and what you said before, the Fed has no model, but they're data dependent. So they look at all these data coming, and what the data coming today are symptoms of what the money supply did 2 years ago. But
Right.
they're looking at the data now, as you say, they got their finger in the wind. They're looking at the data. Everything's slowing down. So what do? They look at the one instrument they only look at is the Fed funds rate.
Is the Fed funds rate.
Lower and they'll
Right.
lower it. So it might look like Trump's getting his way.
But sorry to interrupt, but I just want you to include this in your answer. I'm saying almost irregardless what they do with the federal funds rate, if inflation is coming down, then inflation expectations should come down, and then bond yields should come down because they are a function of inflation expectations, correct?
Yeah, well, that's true, but you've got a Trump factor going in. The trade war and everything is putting a premium on interest rates. That's why interest rates, usually the sequence is the money supply contracts, inflation goes down, and yields go down. Now, if you look at the 10-year, it actually did go down, but it's gone back up. It's about 4.3. I don't know what it is today.
Yeah, it's right around 4.3. It's been bouncing back and forth between 4.0 and 4.5. Yeah.
Yeah. But the point is, it hasn't gone down. Inflation has gone down and kind of stuck, but the bond yield hasn't gone down. Why? Because of the tariff uncertainty, the regime uncertainty, all these uncertainties. Now, back to the borrowing cost, but by the way, in Trump's calculation, he says, well, if you lower the Fed funds rate by 3 percentage points, we're going to save, I don't know how many $1 billion, I can't remember, some triple digit $1 billion of savings.
Assuming they refinance the treasuries this year at the very short end of the curve. Yeah.
Well, no, but but they don't borrow at the short end of the curve. They don't borrow at the Fed funds rate. They can borrow at the short end of the curve, but the Fed funds rate, that's an overnight rate.
Right.
All these calculations are based on the Fed funds rate going down 3 percentage points. It's just the wrong arithmetic. The back of the envelope is not that. The average duration on treasuries is 6.5 years.
Right.
It's not overnight.
It's not overnight, but hasn't Bessent said he's going to continue what Yellen started, which is the 10 trillion that's coming up for maturity this year? He'll just do it in short-term T-bills?
Yeah, that he's going to keep doing that. He says, which I think is probably a bad idea, and it's a bad idea because it will push the 10-year yield up, and the 10-year yield is the thing that mortgages are based on.
Right. It's not going to provide relief there if that sticks.
You end up by shooting yourself in the foot by doing this. Besson's too smart, too smart by half. This is a stupid idea.
Okay.
And more of the same. We get ironically, Trump following the Trump Secretary of Treasury following in the footsteps of Biden's secretary.
Oh, I know, which they were super critical of during the campaign trail.
Oh yeah,
too. Yeah.
This is life in Washington D.C. Well, welcome to Washington D.C.
So let me just ask you this. So I get your point, which is, okay, if inflation expectations come down, bond yields should come down, but they're worried about all the trade uncertainty right now. But as we're getting into this year, at least in theory, we're getting more certainty around trade, right? Trade deals are getting struck. We're kind of knowing what the tariffs are going to be for most countries, at least for now. We're even having certain things like maybe there's going to be a ceasefire in between Russia and Ukraine. Like it seems like as 2025 is going.
You must be kidding. You already put your finger on Trump as a mercurial character, and you said he's using this as a leverage and club. So
Yeah.
that hasn't gone away. It's not Smoot-Hawley where the thing was fixed. It's dynamic.
Right.
It could go south in a hurry. As far
It
as
could, but starting up, but it's not like Liberation Day where everybody was just reeling from, oh my God, these crazy numbers, and how the hell is this going to work? Like we're beginning to get like, okay, this is how it's going to be with Japan, at least for now. This is going to be with the EU, at least for now, right? I mean, isn't that taking some uncertainty out?
I know you're out there in California. What in the world are you smoking?
Okay. Well, no, I mean, look, these are legitimate questions that folks are asking. So dispel them.
My view is that this thing remains very, very uncertain and in play. You mentioned the Ukraine war. It's very clear to me that Russia has certain non-negotiable demands that they've made for a long time. These are all known. The Americans are so stupid they can't get it through their head what the demands are, I guess. And there'll be no ceasefire. Russia is not going to agree to a ceasefire. Now, the one thing they're interested in is a permanent peace. I don't think they're going to get there anytime soon. So this battle is going to continue. So your assumption that somehow the air is going to be cleared in Ukraine it's not going to happen.
Well, I'm not necessarily assuming that we're going to get there. I guess what the question I'm trying to ask is do you see there being a reduction in the bond yield premium that is currently priced in for uncertainty, or is that going to persist?
No, I don't. And in fact, I think the overriding likelihood is that the air is going to start coming out of the stock market bubble. That's one thing we have. You're giving a rosy scenario. The tariffs are. You're kind of in a relief rally mode. You say, "Oh God, the tariffs, they could have been a hell of a lot worse than they are now. Now we know what they are. They might be terrible, but we know. And isn't that wonderful? Let's have a big relief rally." That's basically what's going on in Wall Street right now. And I think eventually people on Wall Street are going to wake up and they're not going to be smelling the roses. They're going to be smelling something else.
Got it. Well, look, if we don't start getting lower borrowing costs, so we stay at high for longer, or God forbid, bond yields go up even higher and we have higher for longer, that's going to pull that's economic gravity, right?
That's where we're going.
That's where we're going. Okay. So so great point, because this is what I was trying to lead the whole thing up to. While you potentially see inflation coming down, right, disinflation,
yes,
you don't necessarily see bond yields coming down.
No, I think real yields will go up.
Okay, real yields will go up, which will, I mean, that's kryptonite to the economy.
Yeah, they have a way to. By the way, real yields have been. We've been living in a world for quite some since the great financial crisis, where real yields were abnormally low and unsustainable. Now I think they're reverting back to the mean kind of. So even forgetting Trump or anything else, if you just revert back to the mean, we got a ways to go.
Okay, so you're in some ways you're referring to the classic chart that we've seen of bond yields, starting from 1980, coming down from double digits to, very low. And the question has been, have we bounced off a low, and are we now going to go into potentially multi-decadal, secular trend of rising bond yields? Sounds like you're saying for the foreseeable future, yeah.
Yeah, I think the huge bull market in bonds is over. I mean, if you look, by the way, at the trend line from the start of the bull market in bonds, the 10-year, I just looked, I cheated a little bit. 10 years yielding 4.33 right now. And where it should be on the trend line is like about 2.7 or 2.8. So it's broken out completely. I mean, the bull market is just completely gone.
Okay, so then as we look into the end of this year, but more importantly, starting next year, looking through your eyes, Steve, it's hard not to see 2026 as maybe a pretty rough year, both for financial assets and for the economy in general.
I think that's a fair assessment. At 30,000 feet, I don't really see that many bright spots. And the bright spots, you know, you got stocks like Palantir and stuff like that. The Economist has a great article on Palantir, and the article is the most overvalued stock in the world. And they have a bunch of comparative statistics, and it's pretty pricey. They say it's much greater than Cisco was before the 2001 crash.
I can't remember what it was, but I was recently told what its price to sales was, and it was mind-blowing. You know, the 10 times price to sales that Scott McNealy railed on with Sun Microsystem back during the dot-com bust had seemed like a high watermark, but this was way.
Yeah, this is on a different planet.
Yeah. Okay, so you know, and
this gets back to my point. Yeah, we're in a bubble. I mean, this is the most overvalued stock in the world. But who says when it's going to pop, or if it's going to pop, or if it's just
a slow deflate? So look, valuations are terrible timing metrics, right? You know, the market can stay irrational longer than you can stay solvent. We've heard that whole quote. I got to say though, I mean, we don't know, but Steve, I got to imagine that you would take if you were a betting man, you would take on this pop, having a notable pop versus just a slow grind, you know, back to normal value, or sideways grind for a long time, back to normal valuations, just because so many of these valuations are so historically extreme right now. And you expect further degradation of the economy. This doesn't sound like a recipe for a slow grind for years.
Yeah, you might be right. We could go through that scenario, because look what I said about Ukraine. You know, a lot of people think things are going to be settled, you know, and I don't think they will be settled. And I think Russia, by the way, has won the war. And the Russian meat grinder will just continue grinding. That's why Putin has no interest in a ceasefire whatsoever. Right. He has a big interest in a permanent peace, by the way.
Sure.
And I think
to stop and keep what he has. Yeah.
I think what they should do is do what happened in 1955 when Austria became neutral, and the peacekeepers. And this is clearly an idea that the Russians have and that go along with the peace, the neutrality. How was that maintained in Austria? The Soviets had a seat at the table. The Brits did, the French did, and the Americans did. And they kept it neutral. It worked perfectly. So that's what they should do in Ukraine. The problem is the Europeans and the United States are having a hell of a time coming to reality and realizing we lost the war. Forget reading the propaganda in the American papers, the Wall Street Journal, the New York Times, you name it. Forget it. It's over. Anyone who knows anything about military operations knows that this thing's been over for quite a while, by the way.
Right. Well, I mean, again, sort of short of NATO / the US getting kinetically involved, what would displace Russia from where it is right now?
Well, nothing.
Ukraine's got the ability to do that.
They're on the verge of literally annihilating the Ukrainian army. I mean, the Ukrainian army, you see these poor Slavs, 55, 60 years of age in the military. I mean, they probably have people as old as me on the front line.
Yeah, which is, again, a human tragedy. So anyway, Steve, nobody knows. You're probably right. I'll hope for better outcomes than that, but
Yeah, what we're saying is the following, or what I'm saying. I'm not saying we're saying it, but I think you're probably more or less on the same page. It, at 30,000 feet, there are a number of as we say in economics, to use jargon, exogenous factors out there that could all turn negative and be a deadly cocktail, changing sentiment and the mood in the market, the irrational exuberance that we have in the market, all these assets and everything now, that could be destroyed in a hurry if things don't go the way the propaganda says it's going to go in the Middle East, in Ukraine, in South Asia, the economy,
yeah.
this, that, you have a whole phalanx of things that actually I think there's a significant non-trivial probability they'll go bad. I think people are sleepwalking into, or shall we say, are a bit delusional. They haven't really thought these things through.
So let me ask you this, Steve, and then I've got to wrap it up here. So you're right that the animal spirits are running crazy right now on Wall Street. Exuberance extremely high. Things have cooled off a little bit over, say, the past week and a half, but I mean, we're still close to all-time highs, and we have these ridiculous valuation metrics on many stocks, Palantir being probably the biggest example, or one of the biggest. But let me ask you this, like, try to make the case for why we should be exuberant right now. I have a really hard time doing it. Like,
I have a total hard time doing it. And by the way, if you look, the one thing that's pulled back a little bit is the NASDAQ, and they make a big deal out of that, that, as they say, the tech-heavy NASDAQ. But Christ, it's right up there. I'm looking at the 3-month chart and right on my iPhone, and it's come off, but it's as high as it's higher than it was on August 1st. It was 20,650, and today it is closed at 21,172. It's higher. In the month of August, it's gone up.
I was going to say, pull back to a year or 2 years. Like, you can't even see this wiggle.
Yeah, no.
Yeah.
So that's where we're at. I mean, you say it's made a correction a little bit. Oh yeah, it's down 3 or 4 days, but
Yeah, it would, but my point is it's still kind of near the red line of hyper extreme. Like, so I can't come up with a narrative to say, well, this justifies why it should be there. It's not like the economy is going crazy. It's not like we've got some massive shoes to drop in the future that should really change things asset price wise for the better.
Well, you've got to look at micro things that might be well priced, and you get, Buffett. What did Buffett do?
Well, he's had a ton of cash, but he did just invest some money in United Healthcare.
Yeah, no. Why? Because he thought it overshot on the downside and was cheap.
Right. Which, I mean, again, that's how you should invest, right?
It's the first time he's laid out over $1 billion for quite a while. He's still got a lot of cash, and by the way, he sold some more Apple.
Right, which he's been doing consistently for a good while now. All right, Steve. Well, look.
So I view that, by the way, as kind of a portfolio adjustment, like the older people that have gone way away from the 60-40 rule, or stocks have gone way up, so they're 85. Instead of 60 top end, and he's sold some Apple just to rebalance. I mean, he's had huge capital gains in there, and I view Apple as not a negative necessarily on Apple, but just a little rebalancing of the portfolio.
Okay. Well, which everybody should do when your gains have become lopsided, right? It's just, again, it's just smart rebalancing, position sizing, diversification. We won't go there, but we could have an interesting discussion about Apple as a company that has not been growing its revenues much for years, yet still gets quite a nice multiple, but that's a different story. So let's wrap it up here, Steve, on this last question. And first, I want to just tell you I appreciate the discussion we've had, because look, it's my job to probe. It's my job to ask the questions that I know people are asking. You did a very good job of fielding them all through this conversation, so thank you for that. But if we can end up where we started, which is, okay, so we have all of these risks here. We have a slowing economy that's maybe on its way to recession, as you said at the beginning. We have, a lot of our financial assets in bubble territory. It doesn't look like, borrowing costs are going to come down anytime in the foreseeable future. That's not a great cocktail. So, do you have any advice for investing strategy in a market like this?
Well, I think the one point that I made early on, if don't get yourself all worked up and excited and decide you're going to jump out and get spooked out of the stock market. I mean,
Don't go 100% to T-bills.
right. Don't do that, because you're eventually going to have to make another key decision, and that's when to get back in. So, so you might have your timing wrong on getting out, and you might also end up having your timing wrong on getting back in, which is typical, by the way. So be careful. And the main thing we talked about is rebalance a portfolio, make certain you've got the thing balanced out in a reasonable way, and buckle up your seatbelt.
Okay. All right. Well, look, Steve, for folks that want to get their own personal copy of Make Money Work, where can they go get that? Like Amazon, anywhere books are sold?
Amazon, it's all over the internet. You can buy it at Walmart or Amazon or any of these any place that sells books online. Wiley is a publisher, and Making Money Work is widely available online.
Okay. And for folks that would like to follow you and your work in between today's video and the next time you come on this channel, where should they go?
Uh, on X or Twitter, as they used to call it, just at Steve_Hanke, and they can follow me there.
All right. And Steve, when I edit this, I'll put up the cover of the book so folks know exactly what it looks like. Folks, I'll have a link to the book in the description below this video. I'll also do the same thing, Steve, with your X Twitter handle there.
Be great.
Steve, I can't thank you enough, folks. Please thank Steve for his very detailed and generous sharing with us here today by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And also, folks, if you want to take Steve's buckle up advice to heart there, unless you have a very successful track record as a DIY investor, managing your wealth successfully through periods like the one Steve thinks we're entering into, I think that most people watching this video would benefit from the guidance of a good professional financial advisor who can come up with an appropriate strategy for them in terms of navigating their financial assets from here, and then executing that for them as well. If you've got a good one who's already doing that for you, great. Don't mess with success. But if you don't, or you'd like a second opinion from one that meets the criteria that we talk about here on this channel, then highly recommend that you consider scheduling a free consultation with one of the financial advisory firms endorsed by Thoughtful Money. These are the firms you see with me on this program week in and week out. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. And as a reminder, these consultations are totally free. There's no commitment to work with these firms. It's just a free public service that these firms offer to help as many people as they can. Also, if you are looking for, our deepest and most intense guidance on how you can prepare for what likely lies ahead in 2026, well, then you should sign up for the upcoming fall online conference that Thoughtful Money is hosting. This one's going to be on Saturday, October 18th. I just announced in yesterday's video, so you can get all the details either by watching that video or by going to thoughtfulmoney.com/conference, where you can get all the details, but you can also buy your tickets at the early bird price discount, which is the lowest price that we're offering. Also, if you are a subscriber to Thoughtful Money's premium Substack, make sure you check your email there. You've gotten a code from me that'll let you get an additional $50 off of that early bird price. All right, Steve, I can't thank you enough, my friend. Thanks so much for sharing your.
Thanks for having me. I enjoyed it immensely.
All right, well, right back at you, and look forward to doing this again soon. And everybody else, thanks so much for watching.